Jake and Marcus are both 30 years old. Same city, same job, same $80,000 salary, same $500 a month they have decided to put toward retirement. They both open an IRA on the same day in January. Jake opens a Roth. Marcus opens a traditional. Neither of them fully understands why they picked the one they picked. Jake heard Roth is always better. Marcus heard the tax deduction now is smarter. They both got their advice from the internet and neither of them ran the actual numbers. Fast forward 35 years. Jake is 65. Marcus is 65. They both retirement on the same day. They both have significant money in their accounts. And then Marcus gets a letter from the IRS that Jake does not get. It is not a penalty. It is not an audit. It is just the bill that was always coming and that almost nobody explains to you at 30 when you are deciding which box to check. Here is the problem with every Roth versus traditional IRA explanation you have ever read. The Roth side leads with tax-free growth and calls it the obvious winner. The traditional side leads with the upfront deduction and calls that the smart play. Neither side runs the math all the way to the withdrawal. Neither side includes the required minimum distributions that force you to take money out whether you want to or not. Neither side models what happens when your tax bracket in retirement is not what you assumed it would be at 30. This video runs all of it. The tax savings going in, the growth inside the account, the tax bill coming out, the RMD rules that can silently push retirees into higher brackets, the income limits that phase out your ability to contribute directly to a Roth, and the number that almost nobody calculates, what the actual spendable after-tax difference looks like at retirement. Between these two accounts when you model a realistic scenario, completely and honestly, by the end of this video you will know exactly how each account works and what it actually costs you in taxes over a lifetime. You will know the specific income and tax bracket situations, where the Roth wins clearly and where the traditional wins clearly, and you will know the one strategy that sidesteps the entire debate for people who qualify. Before we get into the numbers, if this kind of honest, complete breakdown is what you have been looking for, subscribe right now. This channel runs the real math on financial decisions, not the version that fits on a thumbnail, the version that holds up in a spreadsheet. Subscribe and turn on notifications so you never miss one. Let us start with the mechanics because you cannot run honest math on something you do not fully understand, and most explanations of these two accounts stop about 3 steps too early. A traditional IRA works like this. You contribute money from your paycheck before it has been taxed at the federal level. That contribution reduces your taxable income for the year you make it. The money grows inside the account without being taxed each year. And when you withdraw it in retirement, every dollar you take out is taxed as ordinary income at whatever rate applies to you in that year. A Roth IRA works like this. You contribute money that has already been taxed. There is no deduction in the year you contribute. The money grows inside the account without being taxed each year. And when you withdraw it in retirement, assuming you follow the rules, every dollar comes out completely tax-free. No federal tax. No state tax in most states. None. On the surface, the difference sounds simple. Pay taxes now with the Roth or pay taxes later with the traditional. And that is where most explanations stop, which is exactly why most people end up with the wrong account for their situation. Because pay now versus pay later is only the beginning of the math. The critical question is how much you pay and at what rate, and that answer changes completely depending on where you are in your career and where you are headed. The 2024 contribution limit for both accounts is $7,000 per year. If you are under 50, that is $583 per month. We are going to round down to $500 per month for Jake and Marcus to keep the numbers clean and conservative. Now let us look at what each choice actually costs them in year One, because this is the number that drives the traditional IRA argument, and it is real and it matters. Jake and Marcus both earn $80,000. After the standard deduction of $14,600 for a single filer in 2024, their taxable income is approximately $65,400. That puts them in the 22% federal tax bracket on income above $47,150. Marcus contributes $6,000 to his traditional IRA for the year. That $6,000 comes directly off his taxable income. His taxable income drops from $65,400 to $59,400 at a marginal rate of 22%. That deduction saves him approximately $1,320 in federal taxes. This year, that is real money back in his pocket in April. Jake contributes the same $6,000 to his Roth IRA. He gets no deduction. His taxable income stays at $65,400. He pays the full tax bill. The $6,000 going into his Roth is after-tax dollars. He effectively contributed $6,000, but it cost him $6,000 plus the $1,320 in taxes he did not save. His real cost to fund the Roth is closer to $7,320 out of pocket to get the same $6,000. Working in the market. This is the traditional IRA's strongest argument, and it is genuinely compelling at this income level. Marcus gets $1,320 back from the government every year he contributes. If he invests that tax savings alongside his IRA contribution, he is putting more total money to work than Jake on the same gross income. The traditional IRA is not a bad deal in the accumulation phase. Is a very good deal. The question is what the bill looks like on the other end. Now let us run the 35-year growth comparison. Both Jake and Marcus contribute $500 per month. Both accounts grow at the same average annual return of 8%, a reasonable long-term estimate for a diversified index fund portfolio. Neither of them touches the money. Both of them contribute consistently for 35 years. At the end of 35 years, both accounts hold approximately $1,006,000. The math inside the account is identical. The growth is the same. The balance on paper is the same. $1 million in a Roth IRA. $1 million in a traditional IRA. They look equal. They are not equal. And this is where the conversation almost always stops too early. Jake's $1,006,000 in his Roth IRA is entirely his. Every dollar he withdraws in retirement is tax-free. He can take out $80,000 a year and owe the federal government nothing on that income. His $1,006,000 is worth $1,006,000 in spendable retirement income. Marcus' $1,006,000 in his traditional IRA has never been taxed. The government has been a silent partner in that account for 35 years. Patient, waiting, and now at 65, every dollar Marcus withdraws is taxed as ordinary income. If Marcus takes out $80,000 a year in retirement, a portion of that is taxed at his retirement bracket, assuming he has Social Security income and other sources, a realistic effective tax rate in retirement for someone drawing $80,000 a year might sit between 18 and 24%. At a 22% effective rate, Marcus pays approximately $17,600 in federal taxes on $80,000 of withdrawals. His spendable income from that $80,000 withdrawal is $62,400. Jake takes out $80,000 and spends $80,000. Marcus takes out $80,000 and spends $62,400. Over a 25-year retirement, that gap compounds into something significant. We will get to that number shortly. But first we need to talk about the factor that changes the traditional IRA math in ways most people at 30 never see coming. Required minimum distributions. The IRS does not allow you to leave money in a traditional IRA indefinitely. Starting at age 73, you are required by law to Withdraw a minimum amount every year based on your account balance and your life expectancy. These are called required minimum distributions or RMDs, and they exist because the government has been waiting 35 or 40 years for its share of your tax-deferred money, and it is no longer willing to wait. Here is the problem with RMDs for successful savers. If you have been a disciplined investor and your traditional IRA has grown to a significant balance, your RMDs can be larger than what you actually need to live on. You are forced to withdraw money and pay taxes on it whether you need the income or not. And those forced withdrawals can push you into a higher tax bracket than you expected to be in, which means the tax rate on your retirement income can actually be higher than the tax rate you were paying during your working years, the exact opposite of what the traditional IRA strategy assumes. Marcus at 73 has a traditional IRA worth approximately $1,800,000, assuming continued growth after retirement on the portion he has not yet spent. His RMD at 73 based on the IRS life expectancy table is approximately $67,000 that year, combined with his Social Security income of roughly $24,000. Annually, his total taxable income in that year is approximately $91,000. That puts him solidly in the 22% bracket and pushing toward the 24% bracket on income above $89,075 for a single filer. His tax bill on that $91,000 is approximately $14,000 to $16,000. He did not choose to take that money. He was required to, and the taxes are due regardless. Jake at 73 has no RMD requirement. Roth IRAs have no required minimum distributions during the account owner's lifetime. His money continues growing tax-free for as long as he wants to. Leave it there. He withdraws exactly what he needs. His Social Security income of $24,000 is his primary taxable income. His federal tax bill is minimal. He is in the 10% bracket. His spendable income is almost entirely his own. If this breakdown is already showing you the parts of this debate that most explanations skip entirely, go ahead and hit like on this video right now. Takes 1 second and it helps more people find this content. We are about to get to the 25-year retirement spending math, and this is where the full picture of what each account is actually worth becomes impossible to ignore. Let us model the complete retirement spending comparison. Jake and Marcus both retire at 65. Both have $1,006,000 in their respective accounts. Both plan to spend 25 years in retirement. Both plan to withdraw $80,000 per year to cover living expenses. Both accounts continue growing at a conservative 5% annually. On the remaining balance, Jake's Roth IRA, every dollar he withdraws is tax-free. Over 25 years at $80,000 per year, he withdraws $2 million in gross income. His federal tax liability on those withdrawals is zero. His total spendable retirement income is $2 million. Marcus' traditional IRA, every dollar is taxed as ordinary income, assuming a blended effective federal tax rate of 20%. Across his retirement years, Marcus pays $400,000 in federal income taxes on the same $2 million in gross withdrawals. His total spendable retirement income is $1,600,000. Same starting balance, same withdrawal rate, same 25 years. $400,000 difference in spendable income. That is the tax bill. That was always sitting at the end of the traditional IRA road. It was never hidden. It was just never calculated out loud. Now here is where we have to be completely honest, because this video is not complete without the case for the traditional IRA, because there are specific situations where it wins and wins. Clearly, if you are in a high-income year right now and you expect to be in a lower tax bracket in retirement, the traditional IRA makes genuine mathematical sense. The deduction you receive today at 32% saves you more than the taxes you will pay at 18% in retirement. you are paying less overall in taxes across your lifetime. The math works in your favor. If you are at the peak of your earning years in your 40s and 50s, contributing to a traditional IRA and taking the deduction at a 24% or 32% rate today, then retiring on a lower income, the traditional IRA can leave you with more total after-tax wealth than a Roth. If your state has high income taxes and you expect to retire in a state with no income tax, the traditional IRA captures a deduction at a high combined rate today and produces withdrawals taxed at a lower rate in a different state later. The geographic arbitrage is real and meaningful, and if you need the tax savings today because your budget is genuinely tight and the $1,320 in annual tax savings meaningfully changes your monthly financial picture, the traditional IRA gives you breathing room now that the Roth does not. The traditional IRA is not a bad account. It is a mismatched account when people use it in situations where the Roth would serve them better. Understanding the difference is the entire game. Now let us talk about the income limits because this changes the decision for a significant portion of people watching this video. The Roth IRA has income phase-out limits. For 2024, single filers begin losing the ability to contribute directly to a Roth at $146,000 in modified adjusted gross income. The ability to contribute phases out completely at $161,000. For married filers, the phase-out range is $230,000 to $240,000. If your income is above those thresholds, you cannot contribute directly to a Roth IRA. The traditional IRA has no income limit on contributions. Anyone with earned income can contribute. The deductibility of that contribution phases out at higher incomes if you also have access to a workplace retirement plan, but the contribution itself is always allowed. This is where the backdoor Roth IRA strategy comes in, and it is the workaround that higher income earners use to access the Roth's benefits regardless of income. The mechanics are straightforward. You contribute to a non-deductible traditional IRA which has no income limit. You then convert that traditional IRA balance to a Roth IRA. The conversion is a taxable event on any pre-tax money in the account, but if you have no other traditional IRA balances, the tax impact is minimal because you already paid tax on the contribution. The result is effectively a Roth contribution for people whose income disqualifies them from contributing directly. It is a legal strategy. It is widely used, and it exists because Congress created the income limits for direct Roth contributions, but left the conversion pathway open. If your income is above the Roth threshold, the backdoor Roth is the conversation you need to have with a tax professional before your next contribution deadline. Here is the honest answer on which account wins. And like every real financial decision, it is not the same answer for everyone. The Roth IRA wins clearly in specific situations. If you are early in your career and currently in the 10% or 12% tax bracket, paying taxes now at a low rate and locking in tax-free growth for 30 or 40 years is almost always the mathematically superior choice. The gap between your current rate and your likely future rate is working in your favor. If you expect your income and tax rate to rise significantly over your career, every dollar you put in the Roth today is a dollar you never pay a higher rate on. If you want flexibility in retirement to manage your taxable income precisely, the Roth gives you a pool of tax-free money to draw from strategically. And if leaving money to heirs is part of your plan, a Roth IRA passes to beneficiaries without the tax burden a traditional IRA carries. The traditional IRA wins clearly in other situations. If you are in your peak earning years at a high tax bracket and you project a meaningfully lower income in retirement, locking in the deduction today at 32% and paying taxes later at 18% or 22% is straightforward math that favors the traditional. If you need the annual tax savings today to make your budget work and fund other financial priorities, the immediate relief of the deduction has real value that a spreadsheet does not fully capture. And if your retirement income sources are modest and your projected bracket in retirement is lower than your current bracket, the traditional IRA is not a trap. It is a tool that is working correctly. The mistake most people make is treating this as a permanent binary choice. The most tax-efficient retirement strategy for many people is not all Roth or all traditional. It is both. Tax diversification across account types gives you flexibility in retirement to manage your taxable income, minimize RMD exposure, and respond to tax law changes that will inevitably happen over a 30 or 40-year period. Maxing your 401k at work for the deduction while contributing to a Roth IRA for the tax-free bucket is a strategy that does not require you to predict the future with perfect accuracy. Here is the question that cuts through all of the complexity. What is your tax bracket right now, and do you honestly expect it to be higher or lower in retirement? If lower now then later, Roth. If higher now then later, traditional. If you genuinely do not know, split the difference and build both. And if you are in the income range where the Roth phase-out applies, talk to a tax professional about the backdoor Roth before you default to a traditional by accident. Because the account you choose at 30 is not just a tax decision for this year. It is a 35-year bet on where tax rates go, where your income goes, and what the government decides to do with retirement account rules between now and the day you stop working. Marcus got his IRS letter at 65 because he made a reasonable decision at 30 without running the math all the way to the other end. He is not ruined. He built real wealth. He is paying more in taxes than he expected. Not more than he can handle, but more than Jake, and more than he would have paid if someone had shown him this math at 30. That is the only version of this analysis that actually matters. If this video gave you a clearer picture of what the Roth versus traditional IRA decision actually looks like when you run the full numbers, not just the contribution phase, not just the deduction, but all of it through retirement, please hit like before you go. It genuinely helps this content reach more people. Subscribe for weekly videos that break down financial decisions completely honestly with real math and no agenda. And drop a comment below. Are you Team Roth, Team Traditional, or are you doing both? I read every single one.